One thing I think Americans hate more than politics is probably inflation. And I think we can all agree on that because inflation not only robs us of our purchasing power and makes our dollars less and less valuable every single month that inflation ticks up, but also it makes you feel like all of the work that you're putting in towards getting ahead in life and putting food on the table for your family, saving up to buy a house, is all pointless because you can't keep up with it in many cases. Inflation has been consistently outpacing wages for at least the past 20 or 30 years, if not longer, and that's a major issue. And a lot of people are completely fed up with it, including myself. And many of you might have heard that the Trump administration has been consistently trying to pressure the Fed, specifically Jerome Powell, to lower interest rates down to 1%. And I saw a lot of comments on my last video when I kind of mentioned this saying, well, Trump doesn't want interest rates to go down to 1% in order to help the housing market. He wants it so we can refinance the American debt and save us a bunch of money that way. Well, that's great. That is a good idea, but it's going to come at the expense of inflation. You can't have your cake and eat it too in this scenario, unfortunately. Because if the Fed were to lower interest rates down to 1%, inflation would continue to tick up at an even faster clip than it already is. Already, core inflation is pretty much at 3%. That's the metric that the Fed looks at. They've been trying to get it down to 2% for the past 3 years, and it's not happening. So lowering interest rates would just exacerbate that problem. The other thing is that lowering interest rates in order to refinance the debt is just another great excuse to blow up the deficit even more using the new provisions in the big beautiful bill. Anyways, let's talk about how this impacts regular everyday Americans and what might happen moving forward. Now, the Fed has a dual mandate. We're talking about the Federal Reserve here, even though there's nothing federal about it, considering that the Federal Reserve is actually made up of a bunch of privately owned banks. Anyways, their dual mandate is supposedly price stability and maximum employment. And by just taking a quick look around, taking a quick stock of yourself, your opinions, and maybe all of your friends' opinions, you might quickly realize that more people are still far more concerned about inflation than they are about unemployment. In a recent survey, consumers listed rising prices as their main concern ahead of unemployment, a potential recession, crime, or even immigration. And people have been consistently saying that inflation has been our biggest problem. You can see that based on the chart on the screen. And we're already seeing inflation go back up. So if the Fed miraculously decides to lower interest rates, which I think is highly unlikely, but let's say they do, this is just going to make inflation go up even higher. And everyday Americans are saying this is their number one concern, ahead of unemployment, ahead of crime, ahead of immigration, everything. But it seems to be the last thing that anybody cares about, and it's being completely ignored, including by the Federal Reserve, who is supposed to be lowering it to 2%. And if you take a look at this chart here, I want you to pay attention to the black line, because this black line is consumer spending. And what do you notice? Back in 2021 was before inflation became a real issue. Okay, it was starting to build in the background. All the pieces of the puzzle have been put into motion in order to make inflation a huge problem by this point, but people weren't feeling it in their wallets yet. And that's why you can see the consumer spending numbers were much higher, and then they just kind of dropped flat going into 2022 and have pretty much remained about as flat with just a small increase all the way through 2025. But what you notice is now that we're halfway through the year, all the way at the end of this chart, the consumer spending is almost nil. It's almost at the bottom of the graph. And then, of course, we have the looming tariffs in the background that are likely going to bump up consumer prices even higher, which I understand is not the same thing as inflation, but it's all the same thing for everybody who has to pay a higher price. Whether it's through inflation or through tariffs, it don't really matter. It's extra money leaving your wallet each month. And a lot of business owners and CEOs are saying that as soon as there's more certainty on what's going on and all the air is cleared on the tariff situation, that a lot of businesses expect to charge higher prices into the future, which is not really a surprise because prices on everything pretty much never go down. Which is to say that if you think it's bad now, just give it time. It will get worse in terms of the cost of everything. And here's the thing, whenever we had the first big run up in inflation in 2022, it got up officially to around 9%, and they've been able to bring it back down to around 3%, which still isn't good enough. But there's a chance that the second run up in inflation could actually be worse than the first one. And the way we know this about inflation is because back in the mid 1970s and early 1980s, whenever we had a run up in inflation, the second run up in inflation was actually larger than the first one. And bringing down inflation the second time around required a deeper recession and a greater increase in the unemployment rate. So think about it like this. People are not happy with the way things have been over the last few years. Well, if inflation continues to go back up, which it looks like it is, it's going to be an even bigger problem than it has been over the past 3 years. And the thing is, the Fed at least has not been lowering interest rates at all lately, but they may have to raise interest rates again. Most likely they will, as inflation continues to rise. And if that happens, a lot of consumers are going to lose complete faith in the system as we know it. Everybody's been told over the past couple of years that don't worry, inflation's coming back down. We're in for a soft landing. We are going to be in a situation where unemployment's going to remain low and inflation's going to hit 2% again and everything's going to be hunky-dory. But that's been far from the case so far. And I think most level-headed people, including a lot of economists, know intuitively that we should probably be raising interest rates right now. In fact, there's no reason not to, because if unemployment is supposedly low and inflation is not so much of a problem, well, we shouldn't have any reason not to raise interest rates, right? But instead they keep talking about, well, we're gonna lower them, but just not yet. And the excuse that the Fed is using to keep interest rates where they're at is the tariffs. Because they're saying, well, we don't know what's going to happen yet with the tariffs, so we got to wait and see because that's going to make inflation even worse. But as people who know about this stuff understand, it's not the tariffs that actually make inflation worse. It is a one-time price hike, and that's it. Okay, inflation is when we have an increase in the money supply. That's what inflation is, and that's why every dollar becomes less valuable when there's more of them out there chasing the same amount of goods and services. And then you have other people out there who are warning that the Fed could risk a deflationary spiral if they don't cut rates. You know, people are worried that we're going to have deflation. God forbid if prices actually come down, this could be the end of the world for the economy. Take a look at this. Hoisington Investment Management Company warns that by not cutting interest rates, the Federal Reserve risks triggering a deflationary downturn known as a Kindleberger spiral. I've never heard of this term, but let's roll with it. Back in 1973, Charles Kindleberger wrote a book on the Great Depression, and the Kindleberger spiral suggests that when trade barriers rise, the global reserve currency issuer, which is us, the United States, must provide liquidity to prevent economic contraction, and that is a role that the Fed is currently failing to fulfill because they're not lowering interest rates, which means it keeps borrowing prohibitively expensive, which means a lot of companies and businesses just aren't doing it. They also note that the tariffs reduce demand for the goods that are tariffed, which means those businesses are going to suffer even further. And international trade volume has one of the highest impacts on GDP, so shrinking the trade volume also reduces foreign investment in US assets like stocks and treasuries. And they're actually comparing the current situation that we're in right now in the 2025 economy to the situation we were in back in the 1920s and 30s when the Bank of England lost its global reserve currency status. And they're saying because all the other central banks across the world are cutting rates, then we should too. These are some of the nicer houseboats that I've seen here in Sausalito. I've never actually walked down this dock before, but all these places look pretty nice. And in this story, they're actually applauding the big, beautiful bill because they said if it wasn't for that, then we would have tax hikes that go back to 2016 levels that would throw us into a deep recession. So Everybody, as you can see, is concerned about keeping inflation alive and well and keeping interest rates low so we can have a cheap money, cheap borrowing situation for businesses. No one's thinking about the consumer here. Never once did you hear a mention of how any of this affects the average everyday Joe and how much money they have left over in their pocket after paying for all of their expenses. So this is another company that is actually urging the Fed to cut interest rates to provide liquidity and to avoid a deflationary downturn. And they say if we don't do this, then the United States could suffer a major contraction and could risk losing its reserve currency status of the world. Well, I feel like no matter what we do, we're probably going to end up losing that status eventually anyways, because we've kind of just screwed over too many countries at this point with the artificial price of the dollar, because since we can kind of just print as much money as we want, since we are the reserve currency of the world, this has come at the expense of the value of other currencies across the world. And they know that. And that's why we can't rule out the possibility that there might actually be a rate hike on the horizon, not a rate cut like everybody has been calling for. Right now, the only Federal Reserve member that is calling for a rate cut is Christopher Waller, who was appointed by Trump. He says we should cut interest rates by 25 basis points at our next meeting. But he's the only one saying that. But most likely, the remaining FOMC members are almost certainly not going to recommend any changes in interest rates, whether it's up or down, at least for now. But somebody on the committee should be saying, maybe we should be taking a look at raising rates, considering inflation is going back up and the economy is still supposedly healthy. And they're still looking at the official unemployment numbers to say that unemployment is low, which we all know is not true, but that's what the Fed looks at to make their decision. And I'll tell you in a few minutes why that's a huge mistake. Now, the meeting minutes of the last meeting of the Federal Reserve, it says that members agreed that the unemployment rate had remained at a low level and that labor market conditions had remained solid. Members concerned that inflation remains somewhat elevated. And the mystery here is why no one in the last meeting used that last sentence to say, hey, maybe if we need to get inflation down further, we might have to increase interest rates, because that's the only way inflation is likely going to go down, especially if a lot of the tariffs end up taking effect. Because even though tariffs don't cause inflation, they do cause price increases, which will likely reflect in the inflation data, because that's how inflation is calculated by the Fed. They look at price increases across the board of many different products and services. But most likely what's going to happen is they will wait until inflation becomes a major issue again, just like what we saw happen back in 2022. And only then will they likely start increasing interest rates. But we're probably going to have to see inflation tick up a few more notches before they actually wake up and decide to do something about it, because all these people who are in charge are still living in this fantasy world that somehow things are going to turn around tomorrow and on their own without any action on their behalf. And remember how I told you a few minutes ago that I was going to tell you why the Fed looking at the official unemployment numbers in order to make their policy decisions is a mistake? Well, here's why. And it all has to do with the actual job market. Now, back in June, job openings fell from 7.7 million to 7.4 million. Job openings since March of 2025 have trended at their lowest level since 2019. And they say here, well, the good news is that the rate of layoffs has stayed near a record low. Well, every week we hear about all these huge layoffs that are happening. 5,000 here, 4,000 there, 10,000 there, 21,000 here. It just seems to be never ending, but they're saying it's low. But here's the problem. Out of those 7.4 million job openings, many of those positions are never actually filled. And the reason is because of the ghost job listings. A lot of these listings are fake. A lot of them are just up on these job posting websites to make the company look like they're hiring, make it look like they have positions open, when in reality they have no intention to fill probably at least 50% of the jobs that are posted. And we know this because the number of people who were hired in June fell to a one-year low, which is the second lowest level since the pandemic. So we're talking about a hiring situation right now that is just as bad as it was when we were in a full global lockdown. So what does that tell you about the state of the job market right now? Things aren't going nearly as rosy as they're telling us. But they're saying, well, it's not a big deal because the layoff rate stayed at 1%, which is below the 1.4% average that we had between 2010 and 2019. But many Americans are talking about how much harder it is to find a job right now. And let's not forget about how many people are functionally unemployed. You know, we're looking at the official unemployment numbers somewhere in the low fours right now. But the reality is, we have about 24% of Americans who are functionally unemployed. These are people who are jobless, who have stopped searching for work, or people who are employed but earning an annual salary of less than $25,000 per year. And the functional unemployment rate has been on the rise. It actually went up from 22% to 24% in just 2 years. So that number continues to go up. And right now we're facing a job market where 1 in 4 people are functionally unemployed, and there's little sign of improvement. The problem just continues to get worse, not better. So circling back to what I was saying, the Fed is in a situation where damned if they do and damned if they don't. Because if they lower interest rates like the Trump administration wants, they're going to cause a situation where inflation goes up, not down, which is not going to be good for anybody. But the only upshot from that is it could spur more job hirings, more actual people getting jobs. But then, of course, they're going to have to pay people more, which is going to fuel the wage price spiral, which is a situation where employers are going to be forced to pay employees more and more to keep up with the ever rising rate of inflation. And then, of course, if they raise interest rates, you're probably going to see job openings continue to go down. Unemployment might even go up, especially functional unemployment, like we just talked about. We're going to go deeper into this recession. But one thing we have to understand is that either path leads to a recession, okay? Because if they choose the lowering the interest rates route and choosing more inflation, that's going to lead to a recession because people won't be able to afford everyday goods and necessities, including housing. So that's going to be bad. And if we choose the other route, it's going to cause businesses to lay off more people because borrowing costs have become unaffordable for a lot of these businesses. So they will choose not to hire anyone. But the good news there is it will bring inflation back down, might even cause deflation. And I know that's exactly what the government doesn't want. But I think many of us would all want a situation where prices on things actually start to come down. So pick your poison, because no matter what they do at this point, can pretty much guarantee you it's not going to work and it's not going to turn out the way that they're saying it will. So let me know what you guys think about all this in the comments. Let me know what you think is going to happen. And if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here. And I'll see you in the next one.